Hello, good evening. How you doing there? Come on a little bit late today, but I wanted to quickly jump on and tell you about the inflation rate in the UK and the rising cost of things that as prices are going up post the lockdown. And this is the same thing is happening essentially in America. But inflation in the UK reached a 3-year high this week, and it caused stocks to fall back today and gold prices to rise. And obviously, all the gold bugs are saying, yeah, gold's going to go through the roof and that sort of thing. But I'll come on to that a little bit later. But the price of gold was up this week following the figures of inflation, which saw the CPI rise to 2.5%, which is 0.5% above the Bank of England's target. Now, 0.5% doesn't sound a lot, but if you think the target is 2%, then 2.5% is effectively 25% over their target, even though it sounds like a minuscule amount. And gold then climbed to 1,311 per ounce. But gold has been running flat for a long time, so I wouldn't get too excited about this. Gold tends to rise in price during times of fear, like last year, or when there is higher inflation and investors are looking for a hedge against future inflation, because gold over the long term tends to hold its value, and it's seen as a safe haven for investors during times of trouble and turmoil in the stock market. And stock markets have, they didn't drop enormously, maybe 0.5%. The FTSE 100 index was down at around 7,000. Spain's index was down a little bit. The IBEX index 0.5%, no 0.25%. The Shanghai was down about 1%. But so not huge figures, and we know that the stock market is at an all-time high anyway. So this wasn't the straw that broke the camel's back. I think the market was expecting inflation to be high, and the bond market was expecting inflation to be high already. We know that if you look at the shops, and we know how the price of food has gone up, and we are aware that the price of oil has gone up, the price of transport and shipping and all sorts of things have gone up, and those very, very cheap goods we used to get from China don't seem to be around as much now. Even just electrical goods, when I had to replace a small electrical item, well, that's gone up a lot. That used to be, you could get them for 10 or 15 pounds, and now they're 30, 40 and 50 pounds. So I think we all knew that inflation was coming after the end of the lockdown and all the trouble from last year. But the Bank of England are saying, don't panic. They expect inflation to go up to maybe 3% and then peak and then come down. And other analysts have also said that, if people haven't got the money to spend, then prices will have to come back. If people, when these income schemes end and the furlough scheme ends, people are not going to have so much money to throw about. So prices might have to come back because of consumer or lower consumer demand. We've also seen that price of second-hand cars, for instance, has also gone up in the UK and America. This is probably partly due to the fact that the new car production has been slowed down by the lack of these microchips. So there's all sorts of things happening, and and we know that house price inflation has obviously gone up as well. That the Office for National Statistics say that in the past few months, inflation is rising on food, clothing, fuel, second-hand cars. The Land Registry confirmed that house prices were up by over 10% year on year, putting the average property value at over £250,000, 254,000 in the UK, and that's just a little bit less than March's all-time record of 256,000, a couple of thousand less. Maybe the market's slowed slightly as the stamp duty holiday has come to an end at the end of June, and agents are telling me that things are slowing down a bit, but they're not drastically worried. So what does this mean for the economy? Well, I don't think it's going to affect things too much. The Bank of England and the Federal Reserve are also saying that the same thing, that things will peak and then come back again. But we shall have to see. Could it mean that interest rates will go up? Yes, I think if inflation continues to rise, then the usual blunt instrument is to increase interest rates to sort of dampen consumer demand and dampen things down a bit. And that could happen. But don't forget, the government owes trillions of dollars and pounds and euros to bondholders and banks, and all this money they printed, all this quantitative easing. They've got to pay for that somehow, so they can't start jacking up interest rates by 1% and 2%, because it would literally almost bankrupt the country. So I mean, just to explain what inflation is, we saw inflation is very low at the moment and interest rates are very low, but I've lived through inflation when it was like 15-20%. Can you imagine every year something going up by 15 or 20%? Or you can imagine having, £1,000, say £100 in the bank, and next year that pound is, the spending power and the buying power of that pound is only £80. Well, with 2 or 3% inflation, it's not going to affect things a lot in a year or two, because like £100 in the bank, next year the buying power of that money sat in the bank will be £97. But then as it accumulates over the years, you could see that the value of money in cash gradually erodes, and it kind of always has done. If you think about what it took to buy a house, say 10 or 20 years ago, and if you'd bought that house and the house has now gone up in value, and then think about what if you'd left that money in cash in the bank. And some people did this. A lot of people sold properties and sat on cash for years, hoping that the market would come back to zero, but it didn't happen. So we know that the effect of inflation does erode the spending power and the value of cash, and it's especially now as they are printing more of it. And we knew in sort of in Germany in the 1920s and early 30s that time when they just printed money, and then they kept printing and printing and printing, and the money went down in value so much that if you took out a wheelbarrow of cash to buy a loaf of bread and left it outside the shop, someone would take the wheelbarrow and leave the cash because the wheelbarrow was worth more. That's the old story. But we saw in more recent times similar things happening in Argentina and in Zimbabwe, where people that I knew inside Zimbabwe said people have just given up using the Zimbabwe currency. They're now doing everything in dollars or South African rand. And we saw Venezuela as well, where if you just keep printing money and mismanaging the economy, things usually come back to bite you further down the road. Then there's lots of theories about people saying there's going to be a reset. We're all going to go onto Bitcoin. Well, I'm not so sure. I don't think that will necessarily happen. But there is this talk about resets and that sort of thing. But we know that the governments have got to do something to rein this in and eventually stop sort of printing all this money and do something about it. And that will happen. I think that's got to happen. But at the moment, Joe Biden in America is on a big spending spree. But I think in the UK we might be a little bit more sensible. But of course, in the long run, your money is usually better off in assets like property or stocks and shares. If you know what you're doing, if you're investing in the right areas, your money will always grow, and it always has done. Whether it's low inflation, high inflation, money invested in real assets has always done better than money sitting in the bank on deposit, or certainly under your mattress. Gold is another thing. Some people suggest having a small percentage of their portfolios in gold. I certainly wouldn't go all in on gold, but it does hold its value over the longer term. Some people see it as the real money, that if money collapses, you've still got this gold. I don't think money's going to just collapse like that. But gold is quite a useful hedge against inflation. But there have been periods when gold hardly rose in price for years. So you could have been sitting on gold, and then you've got to store it or hide it under the floorboards or pay a bank deposit to store it for you, or some method. And you're not earning any interest on it. You're not earning any money on gold unless you somehow find a way there are schemes where you can rent out your gold. So it's always difficult to know what to put your money in. Property is at an all-time high. So is it the right time to dive into property? Probably not. But if you need a family home, then why not? It doesn't really matter if you buy a family home today and it goes down in value by 5% next year. Does it really matter? Probably not, because if you're going to stay in that home for 10 or 20 years, it will always bounce back. And you've also got to think about the availability of cheap money. Before I remember before the 2008 crisis, when there was this banking crisis, and you know, you could borrow money quite easily. You could get on the phone. I used to phone up my lender and say, look, I need a further advance. And they would just do it on the phone, no valuation. They say, how much do you want? I said, well, I need another 20,000 to buy another property. In those days, you could buy a property with, say, a 20,000 deposit or a 30,000 deposit, because you could get 85% buy-to-let mortgages, in some cases 90% buy-to-let mortgages. And they would send me the money out with a cheque. It was amazing. And if you needed another deal, you do it on the phone. Or mortgages were so easy. In fact, I used to ring up, I think it was Birmingham Midcharge I did most of mine with, a part of the Halifax. You'd more or less arrange a mortgage on the phone. It took about half an hour and that was done. Yeah, you'd have to send some paperwork in and that sort of thing, but it was so easy. Interest rates were a bit high, but you could get hold of money very easily. And then this banking crisis came about, and in 2009-10 there were cheap properties around. I went back to my broker and said, well, what's the situation? He said, well, a lot of the schemes that I think he said he had 2,000 schemes on his laptop, 2,000 different mortgage schemes, and they'd come down to a few hundred. They'd literally pulled everything. There were no more self-certification mortgages. You couldn't just certify your income on a buy-to-let. You had to now provide proof of income. There was no more 85%. That had come right down. It's come back up a little bit now, but not up to what it was. And then it became very difficult to get hold of money. So although interest rates did come down at that point, so the mortgages I had already, I saw a great windfall, because payments were coming down from sort of say 500 or 600 down to sort of 300, and suddenly I was in big profit on the rent, whereas I was just about breaking even before with the higher interest rates. And they fell from, when I was paying 6-7% on interest rates, and they were falling down to like 2, 3, 4%, and it was incredible. But it was difficult to get hold of new money. That's the point I'm making. So now, if you're able to buy a property now as a family home, and you can borrow money at say 1%, or maybe you can get a 2 or 3% fixed for a long time, that could be better to take that money now than maybe waiting for a big crash when all the banks will pull in their reins and stop lending. That could happen. So the last time I found out really what the credit crunch was all about, and it wasn't a breakfast cereal, and literally everything was pulled back. I used to keep a few credit cards with 10 or 15,000 limit, and just keep them there on the side in case I needed money, in case I needed to, because in those days they sent you out a wad of these checks, so you could write out a check and send it off to someone, so you could pay a deposit on a property or something like that, and it would go on your credit card bill. Well, suddenly I found out that these credit cards were not being renewed, or they were reducing the credit limit. So all that available credit was just pulled in and reined in, and never really came back to the same respect. They don't send you out a checkbook with your credit card now. Well, I haven't seen it, and the limits seem to be lower, and they don't increase it so easily. They sort of pull it back. So if you're in that situation where it does become a bit of a credit crunch, then you might be able to buy your house cheaper next year or the year after, but can you get hold of the money? Can you get the mortgage that you would have got now? And is it going to be at the same rate? So that's something you've got to weigh that up, weigh it up and balance that out. So think about that. And, it's obviously your decision. But, in terms of buying a house for the long term for your family home, I think a lot of people have already made that decision this year. They've said, well, we're just going to do it, because even though prices have gone up, yes, the stamp duty holiday did encourage them a little bit to make that move, but a lot of people are still buying. So I can't see an imminent collapse, but you never know. With the stock market so high, it just takes one little panic thing to trigger the market, and it could all come tumbling down, and then property would come tumbling down with it eventually. A very famous investor called Michael Burry, you might remember him from the film The Big Short. If you've never seen the film Big Short, try and check it out on DVD or Netflix or Amazon or whatever. It's a very interesting film. It takes a bit of time to get your head around what's going on. But Michael Burry was played by Christian Bale, and he was the guy playing those drums with the headset with all the heavy metal. But very, very clever investor. He figured a way out he knew that the market in mortgage-backed securities was about to collapse, and he figured a way out of shorting that market. He almost invented a new market for himself to short that market. Shorting means you are predicting that the value of something is going down. So if you short a share, you buy a put option on the share, you're predicting that the value of that share will go down and that you're profiting from it. I won't go into the whole options side of it, but you can profit enormously from that share if it goes down. If it goes up, you lose the bet. But it's a gamble, really. So the upside is very high, but the downside can mean that you lose your money. Whereas if you just buy the share, the upside might not be so high, but if it goes down in value, you still own the share. But with an option, you don't. If it goes down in value and the option expires, you don't own that option. So it's something you've got to really know what you're doing to want to go into options trading. But Michael Burry now is taking huge bets against companies like Tesla and some other tech companies, betting hundreds of millions of dollars that the value will go down. And if he's right, then he'll probably be another billion better off. I mean, in that last 2008, he was a couple of billion up. For him and his investors, by the way, he ran a fund. So just think about that. People like him are betting that certain shares in the market are going to drop. So that's one thing to look at. And we don't know what he's doing really. This has been weaned from 13F filings and that sort of thing, but there could be a lot more going on in the background. Investors like Warren Buffett are sitting on something like 140 billion in cash, and many other investors are sitting on cash waiting for the market to fall or waiting for those bargains. And another way of looking at it is that they feel that the market, there's no value there, that they can't buy anything of real value. And that's a similar way I feel about stock market and property. I feel that if I go out and look at, say, a buy-to-let property, the yield is so small, I can't see the value in buying it at that price right now, even though rents are going up actually. But I just feel I want a little bit more value, and I want to be buying in a market where I can negotiate the price and not been put on a waiting list. So, well, if you ask the offer price, we'll put you on a list and see what happens, and then you enter into a bidding war. No, I don't want to buy a property when the market's like that. I'll wait till things calm down, and then it's more of a buyer's market and not a seller's market. So that's my view on the way things are going at the moment. I hope that's been helpful. If you enjoyed this, please follow me, press a like button, share it so that it gets around a bit more, and the algorithms work in my favor and more people see this free content. Now, if you'd like to learn how to become financially free without working any harder and without taking any unnecessary risks in gambling, for instance, then I put up a free training. You can just click on the link here and you can go to this free on-demand training and look at my tips on how to become financially free without working any harder. When I say without working any harder, I mean without working any harder than you are now, or without working any harder than the average Joe works all his life, like my dad, worked from 6 a.m, came home at 6 p.m, and just barely got by all of his life. So if you want to know how you can get out of that kind of rat race and that treadmill, click on the link below and it will take you to a totally free training that you can get some free content from and benefit from. So thanks for listening and have a great evening, and thanks for joining me, and I'll say goodbye for now. And thanks for everyone on Facebook Live. Ronnie there, great to see you. How are things going there, my friend? Hope you're going well. I think you're in Denmark, aren't you? I think, but great to see you, and everyone who tunes in from all over the world. And I do appreciate your comments and your likes and obviously your shares. So thanks a lot, and have a great evening. Don't forget to click on the link for that free training. Bye for now.